In 2026, dividend investing is still one of the most reliable ways to grow wealth steadily, even in volatile markets. Unlike high-risk growth stocks that can soar or plummet, dividends provide a steady income stream while still allowing your portfolio to appreciate in value. But success isn't just about picking stocks that pay dividends. It's about understanding strategy, timing, and risk management in today's economic landscape. First, let's understand the core of dividend investing. Dividends are payments made by companies to shareholders out of their profits. Some companies pay quarterly, some annually. But the key idea is that these payments are a share of the company's success. Dividend investing isn't about getting rich overnight. It's about slowly building wealth while reducing portfolio volatility. In 2026, with inflation hovering and interest rates higher than they were a few years ago, dividend stocks can outperform cash savings and even some bonds when chosen carefully. A common mistake investors make is focusing solely on high dividend yields. A 10% yield might look amazing, but often these companies are in trouble. Their high payout may be unsustainable, which can lead to dividend cuts or stock price crashes. In 2026, the smarter approach is to look for dividend growth companies that consistently increase payouts over time. Historically, dividend growth stocks outperform static high-yield stocks because they indicate financial stability and strong cash flow management. Next, diversification is crucial. Don't just buy a few familiar dividend payers. Spread your investments across sectors like healthcare, consumer staples, utilities, and technology. For example, utilities and consumer staples often provide steady dividends even during recessions, while tech companies may offer lower but growing dividends. By diversifying, you reduce sector-specific risk and create a portfolio that can perform in almost any market environment. Another key point is understanding dividend reinvestment. Reinvesting dividends can exponentially grow your portfolio over time, thanks to compound interest. In 2026, using DRIP accounts, dividend reinvestment plans is easier than ever, often with no fees. By reinvesting your dividends by more shares, which then produce more dividends, creating a compounding effect that accelerates wealth building over years and decades. It's also essential to keep an eye on tax efficiency. Qualified dividends in the US are taxed at a lower rate than ordinary income, but non-qualified dividends are taxed at your regular rate. In 2026, knowing the difference can save thousands of dollars. Consider holding dividend-paying stocks in tax-advantaged accounts like IRAs or 401ks when possible. This can shield you from short-term taxation and allow your investments to grow faster. When selecting dividend stocks, focus on financial strength and payout ratio. Companies with a payout ratio below 60% typically have room to maintain or grow dividends, even during economic slowdowns. Look at earnings stability, debt levels, and cash flow. Avoid companies that pay out nearly all their earnings. This is often a warning sign that dividends aren't sustainable. In 2026, the goal isn't chasing the highest payout, but ensuring long-term reliability. Now let's talk strategy. Dividend investors often use three approaches. 1. Income-focused, prioritize high-yield stocks to maximize immediate cash flow. 2. Growth-focused, invest in companies that may pay modest dividends now but consistently grow them. 3. Balanced approach, a mix of both, allowing for steady income and long-term growth. For most Americans in 2026, the balanced approach works best. It provides some immediate cash flow while ensuring your portfolio continues to appreciate over time. Timing and patience are critical. Don't buy a stock just because it has recently raised its dividend. Look at long-term trends, 5, 10, or even 20-year dividend history. In 2026, companies that survived multiple recessions and consistently increased dividends are more likely to continue doing so. Avoid making impulsive decisions based on short-term news or market hype. Lastly, keep an eye on interest rates and inflation. Higher interest rates may pressure dividend-paying stocks, especially those in sectors like utilities and REITs, because investors can get safer yields elsewhere. However, quality dividend growth stocks often continue to perform because they combine income with long-term capital appreciation. In 2026, blending dividend growth stocks with other assets like index funds, bonds, or even rescan provide both income and safety. To summarize, dividend investing in 2026 is about more than chasing yield. Focus on financially strong companies, dividend growth, diversification, reinvestment, and tax efficiency. Use a balanced strategy, practice patience, and let compounding do its work. If done correctly, dividend investing can create a reliable income stream, hedge against market volatility, and accelerate wealth building over time. Remember, the best dividend investors aren't the ones who react to every market headline. They are the ones who stay disciplined. Plan for the long term and focus on quality over quantity. Start today, reinvest wisely, and your future self will thank you.